I'm Out Research Market Insights, September 28th, 2023. Hey, everybody, Willie Dowich here. Glad you have tuned in. It is a Thursday afternoon, time for another one of our 3 for Thursday video updates. I'm settling into the whole teaching gig, so time to get back to some of the regular updates here from High Mount Research. So 3 for Thursday, what are we looking at as we approach the end of the third quarter, the end of September? Uh, there's a lot of comments right now about, well, if we just get through September, things are going to improve. We know that September is bad. We shouldn't be surprised by the weakness. Once we turn the page to October, look out, we're in the fourth quarter, things are going to be on the upswing. That might be the case. If so, we're going to have to see some improvement beyond just the change in the calendar. So the 3 for Thursday this week is a look at no fear in the market, no strength in the market, and no relief from rising bond yields. And then the takeaway from that is that if we don't get improvements in those areas, just because the calendar changes doesn't give us a good reason to believe that the market challenges over the past 2 months are miraculously going to disappear. So we'll look at each one of those in turn and then conclude with a look at our sector model and where we're seeing strength, where we're seeing weakness, and how that could be useful as we go into the fourth quarter in determining whether or not we're getting some sort of bounce or some sort of sustainable strength. So let's get into it. We'll start with the absence of fear in the market. Here we're looking at the last couple years since going back to the end of July 2021. What's happened to the S&P 500 overall? It's been basically flat. It's lost a couple bucks. Your $100 at the end of July, if you were in the S&P 500 now, is $98. So basically flat. But if we look at what happens in no fear regimes over the past 2 years, when the VIX has been below 28 and a half, you've lost 28% of your value. When we have seen fear, you've gained 20%. What are we seeing right now? We're seeing the VIX rise off its recent lows, but still well shy of a level that indicates any sort of fear. You can look at this from the perspective of the sentiment indicators as well. We're off of optimism. We're starting to see pessimism expand. We're seeing more bears than bulls now in the AAI survey. The Investors Intelligence bull bear spread this week is below 20. But are we seeing pessimism? Are we seeing fear? I think it's premature to argue for that. And so we're in that environment then where we're moving from optimism to pessimism. That typically is one that is rocky for investors, rocky for the stock market. The absence of strength. Here we're looking at it from the lens, as we like to do, in terms of net new highs minus new lows on the NYSE plus NASDAQ. That's what we're showing on the bottom there. Each one of those orange bars is a single day. The bluish line there is the 10-day average. On the top there, we've got the S&P 500. S&P 500 has rolled over the last couple months. Not surprisingly, has coincided with an expansion in net new lows. The trend there has turned lower. What I want to first do is go back to what we saw going into those July highs for the S&P 500. We had a bull market basically that failed to launch. We failed to see an expansion in new highs, and so that left the market vulnerable to reversal. That's what we're seeing right now. And so if we're not in an environment where we're seeing more new highs and new lows, it's not a smiley face environment, that's a frowny face environment. If October is going to bring a better environment for stocks, I expect it to show up in terms of more stocks making new highs than new lows. And then from a bond yield perspective, lots of talk about what's happening on various points of the treasury curve. Those are interesting, and I don't want to dismiss those, but in terms of actually what a message for the stock market, I like to look at what's going on with BAA corporate bond yields. They've not broken out yet, but they are rising. There is positive momentum in that bond yield. And historically, when yields are rising, the S&P 500 is not. When yields are falling, the S&P 500 is doing very well. Look at it. This is a data table going back to 2000. All the net gains in the S&P 500 in over that, I guess it's 20 some years now, have come when the BAA corporate bond yield was lower than it was 26 weeks ago. Right now, it's rising. That's a headwind for stocks that doesn't go away just because we're in October and not September. And based on what we're seeing in treasuries, there's still plenty of upside pressure on yields as we go forward. When that changes, then we can change with it. Right now, it hasn't. And so while there's a lot of discussion about encouraging developments in October, and what that means for stocks in terms of a better seasonal pattern, if we don't see improvement from a sentiment perspective, from a breadth perspective, from a fundamental liquidity perspective, it's hard to believe that just changing the calendar is going to make that much of a difference. So in addition to these areas, what else should we watch? I've got my eye on what's happening at the sector level. So on the top left here, that's where our sector level trends were at the end of July. We have it broken down by momentum, price, and breadth for all 11 sectors in the S&P 500. Plenty of green there, lots of strength. Momentum was positive, price was positive, breadth was positive. Overall, pretty good trend environment. Fast forward now to yesterday. What do we see? It's a sea of red. Energy is holding on, but elsewhere it's about as negative as that could be. Momentum is negative, price is negative, breadth is negative. And look at it from just an aggregate perspective, and you can see this deterioration that has occurred in our sector level trend indicator. Couple important things here. If the failure to we were negative, made a higher low, then we got negative again, and now we've made a lower low. That was what we saw in the first part of last year. And so where the sector level trend is improving and deteriorating, what's happening correspondingly to the S&P 500. Back then, it was lower lows. Earlier this year, late last year, you went negative on our sector level trend indicator, but we made higher lows in the index. Now that pattern has changed back to what we saw earlier last year. So what do we need to see from this? We need to see a return to positive sector level trends that are sustainable. That's what will make me believe that maybe we could see some sustained fourth quarter strength, rather than just saying, well, we're done with September. Let's assume that favorable conditions are going to re-emerge in the market. Got a couple more charts at the end here, but save those for looking through the slide deck. You can see for aggregate sector level trends, and then also our fear of strength model, what that's telling us. So we'll leave it there for right now. Thank you for tuning in. Thanks for listening. The takeaway here, again, the month is ending. The market's challenges don't necessarily end with it. If we want to see a better environment for stocks, we're going to have to see some degree of fear or some degree of strength. And that's especially if we get that coupled with some relief from rising bond yields, that sets up a favorable fourth quarter. Just moving in the fourth quarter itself, I'm not buying that that's the type of environment that we just need to assume stocks are going to trend higher. So thanks for tuning in. Thanks for listening. I'll talk to you again soon, everyone.